yield back.
Gentleman yields back. The gentleman from California is recognized.
I believe I've already had my 5 minutes. Want to give me another 5?
The chair recognizes himself. I'll start with this. I've been concerned about the CFPB's larger participant rulemaking for some time, and I'm glad that we have the opportunity to explore its impacts further today. First, let's begin with a refresher on what the larger participant rule refers to. The CFPB has 4 broad categories of supervisory jurisdiction pursuant to Dodd-Frank. Number 1, financial institutions with over $10 billion in assets. Number 2, mortgage companies, payday lenders, and student lenders. Number 3, companies deemed quote unquote larger participants in a consumer financial market. And number 4, companies designated by CFPB as a potential risk to consumers. If unchecked, that third category, the larger participant category, is sufficiently broad as to potentially expand the CFPB's jurisdiction dramatically over time. I fear that we are seeing that with this rule today. One example of how this rule expands the CFPB's reach hasn't gotten much discussion to this point as it relates to merchants. The CFPB is explicitly barred from supervising merchants pursuant to Dodd-Frank when they are selling non-financial goods. This is a common sense guardrail. The CFPB is a financial regulator. They don't have supervisory authority over non-financial merchants in the country, and they shouldn't. However, I feel this proposed rule takes that boundary and pushes it away. One piece of this rule claims that at any time a merchant uses consumer payment information for something other than completing the transaction, including for benign purposes like research, they go from selling a non-financial good to a financial one and are therefore within the scope of the rule. Let's step back and think about that for just a moment. When a completely non-financial merchant conducts research on their payments data, even for a good reason like conducting research to stop future fraud, they could be subject to CFPB supervision. For example, if a consumer buys a recliner chair at an online furniture store, whether or not that transaction is considered a financial transaction by the CFPB would depend upon exactly how the merchant treats the information associated with it. According to this interpretation, the fact that we're talking about a merchant selling a piece of furniture is irrelevant. The CFPB still may have jurisdiction anyway. Conveniently for the CFPB, this could extend their supervisory authority to merchants selling any and all kinds of goods. This interpretation allows them to go from a financial regulator to a regulator that could have authority over anything sold online. Another way the rulemaking expands CFPB's authority is not just over U.S. dollar transactions, but digital asset transactions. Again, this would be a broad expansion of their power. Mr. Johnson, in your testimony, you connected the CFPB's jurisdictional grab over digital asset transactions to major questions doctrine from the landmark West Virginia versus EPA case. Do you believe the CFPB has clear congressional authorization for its claimed authority over digital assets? And please explain why or why not.
I don't believe it has that authority because Congress didn't give it that authority and didn't give it that authority expressly in Title 10 of the Dodd-Frank Act.
It's a relief to hear you say that because the members of this committee have been working on delegating authority to our regulators over digital assets for over a year. It would be rather discouraging if the CFPB could simply claim authority over the space with a stroke of a pen and very little legal basis. I'd like to close today by bringing up one more issue with the proposed rule. It completely failed to assess its potential impact on small businesses pursuant to the Regulatory Flexibility Act. The rule certifies that it will not have a significant impact on small entities, but does so with no serious analysis. This is despite the fact that small businesses and sole proprietors are some of the most common users of third-party payment technology that could be clearly covered under the rule. Mr. Holzhauser, you mentioned the lack of analysis regarding the rule's potential small business impact in your testimony. Would you provide some additional thoughts on this topic?
I'd be happy to. I think small and medium-sized businesses have no idea whether or not they're covered under this proposed rule, and that in and of itself is the problem. We're hearing an estimate of 17 covered firms, but I think the estimate could be well in the hundreds. But if you're a small business and you're making a decision between spending money on compliance costs to deal with this new proposed regime versus innovating new products and then selling them, which is the lifeblood of creating a new business, you're going to see a real headwind in your ability to maintain and grow. And I think if you limit and define the scope of this proposed rule in a more targeted basis, you will certainly give more certainty to businesses who are really confused about whether or not they'd be caught into this and what that means for their ability and need for raising money to grow.
Thank you very much for your testimony. I now recognize the gentleman from North Carolina.
Thanks to our chair and our ranking member and our witnesses for being here. I represent North Carolina's 13th district, and I've said this before, the work of the CFPB is incredibly important. Their mission of protecting consumers is supported by the vast majority of Americans, regardless of political party. The CFPB recently released their larger participant rule for digital consumer payment apps in November. I understand the goal of this rulemaking, as millions of Americans are now using digital payment apps. However, I'm concerned that this rule is overly broad and lacks clarity. Mr. Holzhauser, as my colleagues have mentioned, the CFPB indicated that 17 companies will be covered by this rule. However, they refuse to say which companies. Is that standard practice? What purpose is served by keeping the list of companies who would be impacted by this rule secret?
This is not standard practice, and I have no idea what this serves. Certainty is what businesses need in order to operate their businesses and know how to plan. And this lack of specificity is a real concern.
Mr. Holzhauser, and again to you, given the uncertainty surrounding this rule, will companies be discouraged from offering payment services to consumers, and how will this impact competition and innovation?
Absolutely. I think it will decrease the players in the market and reduce new entrants. It will cause those that are in it who might be caught up in this rule to retract from this market, which will lessen the number of products and therefore hurt competition.
Thanks. Mr. Kim, next question to you. To justify the rule, the CFPB only performed a cost-benefit analysis of peer-to-peer products. However, the rule would cover products like Express Checkout that have nothing to do with the peer-to-peer cost-benefit analysis. Is it right for the CFPB to propose such an all-encompassing rule when they don't have adequate data to justify it?
I agree that the proposed rule conflates, very separate and distinct payment products and functionalities. It doesn't explain why it does so, and in not explaining why it conflates them, there's no cost benefit or any sort of empirical analysis to support that kind of overly broad definition.
Mr. Kim, again to you, how is this larger participant rule compared to previous larger participant rules?
Well, with prior ones, we weren't asking these questions. Like with student loan servicing, everyone knew who the big players were, and I don't think people really debated or had much concern about whether the threshold would capture the large ones versus the small ones. I think today's hearing highlights how there's a lot of uncertainty about the scope of the rule and its potential impact.
Mr. Kim, again to you, can you walk us through what a typical supervisor examination by the CFPB would look like for firms identified as larger participants, and describe what powers the CFPB has over an entity once it has been designated as a larger participant?
Well, they send examiners, and it's typically at a minimum several, but easily 20 to 30. And for large tech companies, I would imagine the CFPB would, bring its so-called A game and bring as many as it can. It would be probably a combination of hosting them on site, but also hybrid or virtual. And these exams last months, so we're talking about, wave after wave of information requests and follow-up requests. And then, companies often field those questions for over a year, and then maybe you might get an exam report, a year or two later. So it's significant. People have to kind of drop their day jobs to respond to the information requests and exams.
Thank you, and I yield back.
Gentleman yields back. The gentleman from Florida is recognized.
Thank you, Chairman. Wow, this has been a very interesting hearing. I say often in this room that the first hearing I ever watched as a citizen of this country was the financial services hearings when Dodd-Frank was being created. I was in the finance world, not a member commenting on the finance world. And to be blunt, and no disrespect to the staff on Capitol Hill, not a staffer writing memos about the financial world. I was actually doing it. And a lot of the things in Dodd-Frank concerned me. Most overall overarching was the CFPB. And the concern was that the CFPB would be this overarching agency with no real oversight that would just roam the fruited plain trying to figure out what they can meddle in. And obviously we're doing that today. Mr. Holhauser, we get very technical in financial services. For the people watching at home, what actually are digital payment systems? What are the actual pieces of technology we're talking about that would apply to the American consumer?
Well, that's an incredibly complex and diverse question with a lot of different aspects to it.
Just give me an example.
But you're running financial transactions through a large digital pipe, through a bunch of data centers back and forth between merchants and banks, with other regulated entities in the payments ecosystem also involved in that.
Would a digital wallet be a part of this?
That's subject to interpretation, but normally, yes.
Okay, so I'm a consumer. I go on my phone. I download a digital wallet. I could put crypto, stable coin, or potentially even cash in this wallet. Would that all be subject to the CFPB's rule?
Under the proposed rule, yes.
Okay, Mr. Odenet, Professor Odenet, question for you. Even in its infancy, when Dodd-Frank was being created, did the members, I will say the Democrat members, because they're the ones that voted for it, did they truly think that it would make it possible that the CFPB would regulate consumer transactions between consumers?
So I wasn't involved in that process like you. I was much younger. But what I do know is that Congress intended for the CFPB to have jurisdiction over non-bank, non-depository institutions involved in the provision of consumer financial products and services.
I don't want to overly interrupt because we're short on time. Do you know why they did that? Because of the lending market, because I was a lender at the time. And in the lending market, the issue was home mortgages, specifically ninja loans, where you could show up, say, I want to buy this house. You have no credit report, no income verification, and a non-bank issues you a mortgage to go buy a house that you can't afford. Isn't that correct?
So I think that the subprime mortgage crisis was at the forefront of Congress at the time, but that doesn't mean that the Bureau's authority is limited to the mortgage market. In fact, the text of the Consumer Financial Protection Act goes far beyond that into multiple different types of consumer financial products.
Well, Professor Odenet, I would like to opine on that. That's why Dodd-Frank is trash and is one of the worst pieces of legislation ever contemplated by this body. But let me move on. Do you think that digital wallets pose a systemic threat to the United States of America?
My understanding is that the Bureau is not making its rulemaking on the basis of systemic threat, but on the threat of consumer harm in the offering of that.
Is there a
product or
consumer
service.
harm in Americans being able to actually use their resources to buy goods and services from a business, a merchant, or from another individual?
Under the limited facts of your question, no.
Okay. Is it plausible that an American citizen needs a license or needs authority from or approval from the CFPB in order to transact business and commerce?
No, but the businesses that facilitate it do.
You said in your statement that, and I want to say, quote, that businesses could discriminate based upon information that they take down in the normal course of business. Is there any evidence at all that there's been any discrimination with the use of digital wallets at all by these tech companies?
I think proper supervision will reveal whether or not that is the case.
Mr. Johnson, is there any discrimination that's been found by any of these tech companies or fintech companies actually allowing for these products to be used by consumers?
Not that I'm aware of for laws that are within the CFPB's jurisdiction.
Here's a question for you. Do you think the CFPB even has evidence to the fact that there might be discrimination with the use of any of these products by consumers?
I think the Bureau's articulated concerns in speeches and other communications speak to speculative concerns rather than actual observations of marketplace behavior.
So for the people watching at home, the CFPB is looking for something to do because they are busybodies. There is no need for them to regulate in this space. Mr. Chopra, once again, is way beyond his bounds, which is why this agency needs to go away permanently. I yield.
Gentleman yields. Gentleman from Illinois is recognized.
Thank you, Mr. Chair, and to our witnesses.
Mr. Odine, in your testimony, you note that many of the firms that we expect to be covered under the larger participants rule are large non-bank tech firms, and with business lines that benefit from the mass collection of consumer data. Typically, we think of this through the lens of marketing, usually insights gleaned from interactions with your favorite search engine or social media app to shape targeted advertisements that are more likely to get you to buy something. Others have relationships with third parties who may also have access to consumers' information. As you note, large payment providers have access to a very valuable trove of financial information about their users that can show how much they spend, where they spend it, and how they manage their finances. Now, I imagine that most consumers would deem that sensitive information. What are some of the risks of non-bank financial firms having access to that sort of information, and what safeguards do you believe are missing?
So as I mentioned in my written testimony, one of the most important and profitable kinds of information is how people spend their money. And that is exactly the kind of data that these payment processing, payment platforms are able to generate and capture. The fear, to my mind, is the ability to use that kind of information coupled with other types of non-financial consumer data, browsing histories, social interactions, et cetera, and in combination engage in activity relative to targeted marketing, price differentials on products and services that is unlawful, that is discriminatory.
Yeah, and there have been instances where perhaps even inadvertently some of the AI algorithms of some of the big firms have been doing things like, digital redlining that have, have resulted in real harm to American citizens. So how do the risks change when the firm has significant lines of business that are outside the financial services sector?
So I think this goes toward the question earlier about the separation between banking and commerce. The way in which non-bank, which is to say non-depository institutions engage in the payment ecosystem places them outside that division because they're not depositories, they're not falling under the Bank Holding Company Act. And so that allows for a level of sharing and interaction and penetration between the payment side of the house, if I can, and the commercial, we'll say the tech side of the house. And it's the combination and the interaction of those two lines of business and the data that they produce that I think poses the risk of creating these multidimensional, very granular profiles about people and how that granular information can be used in ways that we would find problematic.
In recent months, I've been happy to see the CFPB take steps to give consumers greater control over their personal financial data. While the details of the proposals are still being hammered out, the Bureau's 1033 rulemaking, I believe, is an important step to ensure that consumers' data is protected and that they have the freedom to walk away and move their data to another bank or financial institution when they determine that they could be served better. So my question is this, how does this larger participants proposal interact with other consumer protection laws, and what would it mean for something like the 1033 rulemaking?
So I think the way that supervision interacts with this idea, which you speak of, which is generally referred to like a component of open banking, is to ensure that those non-bank institutions that are covered by the rule, that are required to generate consumer data in an interface that's standardized and easily shareable, which includes, as you say, controls on how much of it is shared and the need to get reauthorizations on an annual basis are being complied with. That's what supervision is. It's not to impose new rules. It's to ensure that the rules that already apply are being abided by.
Thank you. And how does the lack of supervisory authority over digital payments applications hinder the Bureau's ability to protect consumers' financial data right now?
The problem is that when there are breakdowns in compliance with the consumer financial laws like the Gramm-Leach-Bliley Act or others, if the Bureau does not have the ability to monitor on an ongoing basis that level of compliance, the public generally does not discover misbehavior and wrongdoing until the consumer harm has already happened. I think it's also worth saying that there are benefits to supervision that were not mentioned at all today. One being, we often hear about regulation through enforcement and the fear of CFPB enforcement, but supervision happens on an ongoing basis and in a confidential capacity so that the business and the Bureau can engage in an ongoing dialogue, flag problems and resolve them before they become public.
Thank you, and my time is up, and I yield back.
Gentleman yields back. Gentleman from South Carolina is recognized.
Thank you, Mr. Chairman, and thank you to the witnesses for being here today. When examining the larger participant proposal, one cannot help but see it as another power grab from Director Chopra at the CFPB. Since his swearing in, he has consistently applied liberal academic theories with no common sense or basis in the real world. Time and time again, these theories are put into practice and result in increased cost for services, unintentionally hurting consumers instead of protecting and promoting their best interests. What is worse is that these consequences are foreseeable and even predicted by the seemingly ever-increasing chorus of those of us with business experience. Yet our warnings are perpetually cast aside. It seems that the only possible course correction will be either Tuesday, November 5th, 2024, or who knows, perhaps the Supreme Court. But for now, I guess we will continue to highlight the adverse consequences of CFPB's proposals. This time, the directors become even more emboldened, stating that the CFPB's supervisory authority is not limited to the products or services that qualify a covered institution for supervision, but could essentially capture every aspect of a given business, subjecting companies that largely provide services outside of the financial sector to the CFPB's oversight. Not only does this proposal appear to be broad, it's incredibly ambiguous, leaving many market participants questioning their status. Mr. Holzhauser, the CFPB identifies 17 firms as potential larger participants under the proposal. However, the CFPB has collected data on almost 200 companies in consideration of this rule. To say the least, it appears there's widespread confusion among market participants, with many companies unsure of their designation. Given the ambiguity in the CFPB's definition of the market in this proposal, are your member firms able to say with certainty whether they're covered?
No.
Do you think that's a problem?
Market uncertainty is the bane of the existence of any business, but particularly small and medium-sized businesses trying to grow. And the 17 that are mentioned don't account for the hundreds more that are in the space that are sitting wondering, am I going to be covered under this? Even though I'm a small company, maybe I have 20 employees.
Businesses, no matter what size, want to compete on an even playing field, and they got to know the rules of the game in order to compete. This is not productive. Mr. Kim, do you find it appropriate for this rule to encapsulate both companies that facilitate transactions and those that provide a native digital wallet? And what is the CFPB's justification for such a broad scope?
I don't see the justification in the proposed rule for combining what I think are very different functionalities with different risk profiles. If you're, as I read the proposed rule, if you're merely saving and passing payment credentials and instructions, but not actually touching the money in any way, you're still covered by the rule. And then you're treated the same as a company that actually holds and moves the money. So I don't see the explanation in the rule for treating those two very different things the same way.
Unless you see it for what it is, which is just a way to expand their authority and have additional scope. Mr. Soloway, in this proposal, the CFPB includes digital assets and their definition of funds. This committee has been crafting legislation to address digital assets, yet it appears the CFPB is trying to front-run Congress and expand its authority. What potential implications could this proposal have on the digital asset ecosystem?
If the CFPB were to succeed in, as you put it, front-running Congress, it would not only add additional regulatory uncertainty to an already uncertain space, but one of the specific risks would be the application of this rule to self-hosted crypto wallets that do not exhibit the same underlying technological structure nor the same risks as more traditional digital payment apps.
Mr. Soloway, this seems like a radical expansion of the CFPB's authorities. Could the CFPB use this novel interpretation of funds in future proposals?
If unchecked and unchallenged, they could. In addition, they could take away the lesson that they can interpret and expand their authority broadly.
Also, Mr. Soloway, given the unique nature of some digital assets, does the CFPB provide sufficient guidance on which digital assets they would consider to be funds and which would be excluded?
No, they do not. They provide little by way of guidance, which is to say essentially none at all. There are very different types of digital assets out there, and the failure to distinguish between them is one of the shortcomings of the proposed rule.
I'm not sure what this proposed rule helps. It literally only seeks to expand the director's authority, and it further complicates businesses' ability to compete in the U.S. and global economy. And I really think it needs to be reconsidered. But again, as always, I imagine that our Warnings will be cast aside, and it'll take the Supreme Court or an election to change course. With that, Mr. Chairman, I yield back.
Gentleman yields back. I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. This hearing is adjourned.